The following is a presentation of TFNN. Live at TFNN, the Small Cap Roundup, with your host, Kate Stalter. Now, Kate Stalter.
Oh, good morning. Happy Thursday. Welcome to the Small Cap Roundup. I've put up there on Tiger TV, if you're watching, a chart to show you just how not great it's looking today, not only for the markets in general, but for the small caps. I put up a chart of the IWM, the Russell 2000 ETF. Now, that's a daily chart if you're watching on Tiger TV. And you can see where it's pulling below its 10-day average. Now, I'm going to go over here just very quickly because I've got a guest I want to introduce. I'm very excited to introduce, but I do want to show you this. If you look on a weekly chart, you do still see support above the 10-week line, so it doesn't really look as bad on a weekly chart as it does on a daily, which is why it's such a great idea to always use dailies, weeklies. I also use some intraday in my analysis, and I use monthly, but not really as a point of making entry and exit decisions, just more to give me some overall context. So anyway, there's a look at the small cap Russell 2000 ETF. So one of the things that I'm pretty excited about today, we've actually got two guests on the show today, so this is going to be a little different than we normally do around here, but this should be a lot of fun, and I do want to encourage people to call in today and ask some questions of our guests. We have today on the line my friend Hank Mulvihill, and one of the things, I know a lot of the folks in our audience are interested, listen to TFNN because you're traders, or maybe even on your investing, you kind of tend to not to stay too long necessarily in some of these. You're not looking at buy and hold trades necessarily, and in some of your accounts anyway. So, you know, we talk a lot on here about how does the big picture economic macro view affect things, and as you know, we've talked about it with several of our guests in the past, that, you know, you get people, some of these analysts who make these grand economic pronouncements, and maybe they're right, maybe they're wrong, who knows? It doesn't matter, because you really, as a trader, you're going by what the trend is showing you, what the chart is showing you, and that may have little or nothing to do with what some analyst is pronouncing. However, Hank Mulvihill. Hank, I want to say hi and get you in on this while I'm introducing you here, because you know, Hank, one of the things I know that you are a very well-known advisor down there in the Dallas area, and we have some mutual friends like Fred Richards, for example. I know you'll talk about him in a moment when you talk about your Fed Friday event coming up. But you're a trend follower yourself, but you also are able to blend this with some of the macro picture, particularly with regard to what the Fed is doing. So I want you to tell our audience a little bit about what we as traders need to know about the Fed.
Well, hi, Kate. Thanks for having me on, and let's get right to it. Today is a pretty good example of watch what's going on in the credit markets, and the most influential actor in all of global finance by far is the Federal Reserve. Why is that important to what you're trying to do on a daily? And I'm not in favor of day trading, but in a short term, I don't see anything wrong with an intermediate trade posture and taking profits when you can. So that's my bias. I'm definitely not a buy and hold person, nor am I a day trader. I understand people can be successful at by the tick trading, but it's very difficult to do on a long-term basis. So my bias comes about that, and I really think that you can pull up any of the charts of the S&P and contrast those against the quantitative easing periods, including the current one called Operation Twist, and it's quite obvious that the Fed does support the equity markets and does drive down yields. And if you just don't understand that, then you're going to be trading against the most powerful actor in global finance. it's very important to understand which way the wind is being blown. I use my words carefully because it isn't natural, but it is in the markets. And so that is why I pay so much attention to the Fed.
Give us a little picture then of what we're seeing right now, because one of the things, you're always out there getting speculation from the media, and every single word that Bernanke utters that comes out of the Fed statements, every single thing is just parsed to the nth degree. So what should we be looking at right now, Hank?
Well, the markets are telling us that something has changed. About a month ago, the Russell stopped outperforming. And that's very interesting in the middle of a Fed easing, which we still are. Operation Twist is not scheduled to burn off until June 30. However, go back and look at the previous episodes. Somewhere around March-ish, certainly May-ish of the past 2 years, we've had that correction that everybody keeps waiting for. In addition, as if this is an audience of short-term small-cap traders, they already know what I'm talking about on the Russell, which has ceased to outperform for the last 30 days. We get that. What we don't get, and I do a fair amount of speculation in what I call my personal hot account. I don't bring that to the clients, but it lets me get a feel for what's going on and breakouts and breakdowns. What I'm seeing in that side of things is not a responsiveness to the low VIX. It's been a very perplexing short-term trade. All of the small cap and all of us who are focused on the short end know that, and I keep coming back to that, although I run money for clients differently, I do test my theories intraday. There isn't a responsiveness to the low VIX that we would have expected by now. And by that I mean we should have seen some kind of a snapback, and we haven't seen it unless you count today's move, and it's not conclusive for one day.
But, and we had that big move yesterday as well to the other side.
Yep, I know. And then the other thing that's happened, I'm talking about the Russell, which is about 30 days worth, and that's what's happened in longer-term yields over the last 8 trading sessions or so. Extremely sharp spike upward. And on the 10-year Treasury, for instance, and again, this may be of no interest whatsoever to the small-cap trading world, but it should be.
No, definitely,
when you go from a 1.95 to a 2.40 in 4 trading sessions, that's fairly stunning.
Right.
Now, we've come back down a bit from that, but there are some, including Fred Richards, who I mentioned earlier, who feel that the Fed may be losing a bit of a control on the long end. I, as you know, am biased. I don't think they ever lose control of anything.
Right.
Because they have all the money and power in the world, and that's just the way it is. But I think that, gosh, how to get through this chop here? Just an eagle-eye focus on those changes in fixed income. They're very indicative. It's a much bigger market than the equity markets. For those who trade the various derivative products in fixed income, they're already knowing what I'm talking about. And yes, that volatility is absolutely showing up there.
What changes, I think you were kind of alluding to this a little bit, how should people at this juncture maybe be reevaluating their portfolio or rebalancing some of their asset allocation? Anything you're seeing there, Hank?
Oh, I don't know. You should have put it all on Apple, right?
There you go. That's right.
I mean, we talked. You interviewed me. No kidding. You interviewed me at the New Year, and I said at the time in jest, and I called it a joke at the time, that really the only sector worth playing was the sector called Apple. And good grief, Kate! I mean, up 50% year to date. So at some point, do trees grow to the sky? I think probably, and most people I know have an Apple product either in the pocket or on the desk. And does that continue forever? I don't know. Is the company valued fairly? Who knows? And I think it's such an outperformer in so many ways. Apple alone, by itself, has accounted for something like 30-ish, 33% of the growth in the NASDAQ 100 this year. So that's pretty much an outperformance there. Your question is what to look for right now. I think if you get any weakness in that stock, it's very ill wind. It's an ill wind for the market as a whole.
That's interesting. So it's actually it could be viewed as a market indicator at this point.
It is really a amazing, dominant aspect of equities at this moment. There is no one who's going to be out of Apple going into March 30. I mean, what fund manager is going to want to say they don't own Apple? but after that, I don't know. You could see some protective action there.
You know, that's true, because I do talk to a number of small cap, mid cap asset managers, and really it's so funny because so many of them do say, oh, we're in Apple, even though that's not really, doesn't fit in with the fund's stated objective. If your objective is to make money, you want to be in there. So it's been pretty interesting.
I know. It does tickle me. Apple long since ceased being a small cap, and that gets into my personal rant about the 9 style boxes. You know, I mean, come on, Microsoft was a small cap at one point, Apple the same. But eventually they aren't. And do you leave them because of a designation? No. You stay with what makes money.
Right. You can come up with a convenient excuse either way, I suppose, to support whatever thesis you're trying to support.
Just saying.
Yeah. Hey, we've got a break coming up here, but if you can, actually, we've got a couple minutes before the break, and I want to give you a chance to talk about this really incredible event that you've been running for the past few years that's coming up next week. And I'm wondering, Hank, if you can we can start now to talk about Fed Friday, and if you can stick around through the commercial break. Are you able to do that?
Sure, Kate, thanks very much. And I'll just start, and you cut me off when it's time to go to break.
Okay. You'll hear Tom Petty.
Okay, here we go. Fed Friday, and that's fedfriday.com, Fed like the Federal Reserve, Friday like the day of the week, fedfriday.com. Please go look it up. We have an incredible program, March 30, Dallas, Texas, easy to get to from wherever you are in the country. $50 gets you a good lunch, gets you about 4 hours of heavy-duty macro stuff, and how you can bring that to a portfolio. That's the whole thesis of Fed Friday. We've been doing it for 10 years. I started talking about these big flows and the craziness of American finance way before it was cool, way before anybody knew what the financial meltdown of 2008 was going to look like. And we were talking about those imbalances. We're still talking about them. We're talking about how you can make money in the middle of them. FedFriday.com. Great guest speakers. We have actually a Federal Reserve senior economist who's going to be on stage at the same time with an outright gold-backed currency advocate. Now, that probably won't happen again.
That sounds pretty interesting. I think we've got our break coming up here in a second, so after we come back from that, Hank, what I would like to do is ask you to tell us a little bit more about some of the speakers and really how individual investors do need to put all this in context, because that's the point. So hang in there with us, Hank, and we will be back in just a few minutes with more on the Small Cap Roundup.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
TFNN is proud to bring you the cutting edge of investment newsletters. Ken Shreve's Ultimate Growth Stocks. Ken is a top-down investor who lets price and volume in the major stock indices tell him when to be in the market and when to be out. By using his unique blend of fundamental and technical analysis, Ken will protect your hard-earned capital while realizing breakout gains. Go to TFNN.com today. Click Investment Newsletters and get Ken Shreed's Ultimate Growth Stocks free for 2 weeks.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of The Money Game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and the Money Game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital, versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about the Money Game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
X-Story Gold Mines, an NYSE Amex-listed company trading under the symbol XG, is slated to be the newest gold-silver producer in Argentina. X-Story is forecast to produce more than $250 million in bullion annually, beginning in 2013, at a cash cost of less than $200 for each ounce of gold produced. That forecast will make X-Story one of the highest margin operators in South America and a sector leader in the mining industry. X-Story has $50 million in its treasury, having spent over $60 million to date on drilling and engineering. The ultimate size of its Argentina discovery could be determined by year-end, as results from the 6 drills operating at the site are fully assessed. To find out more about X-Story Gold Mines and their exciting growth potential, click on their banner on the front page of TFNN.com or check them out on the NYSE Amex under the symbol XG.
Here's what people are saying about Tiger TV.
Let's go to John in Tampa. Hey, John, what's going on?
Hi, Tom. How are you, sir?
I'm doing great. You having a good day out there?
A wonderful day. I love your Tiger TV. I watch it every day. I'm like a kid in a candy store.
Oh, man, I appreciate you out there watching it. How long have you been watching the Tiger TV?
I'm watching almost a month now, and it's wonderful.
It's pretty cool, isn't it?
Oh, yes, it's cool. You see the charts and everything. Thanks so much for the hard work.
Tiger TV, a great news service from TFNN.com. This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
Okay, we are back here with the Small Cap Roundup. Looks like in the last few minutes, stocks are off earlier lows, actually moving up a bit as the president is speaking. And I know a lot of people tend to joke about stocks trading lower while the president is speaking. And that I've noticed that happens whoever is the president, by the way. That just seems to be often a phenomenon. We're here joined by our guest, Hank Mulvihill, who is the organizer and head honcho of the Fed Friday event happening in Dallas next week. Hank, give us a little bit of background. How did you to start this event?
Oh, I've been an investment manager since 1987, and it frustrated me that very few people talked about the big influences, and particularly the Federal Reserve. And it frustrated me even further, circa 99, 2000, 2001, that very few people got out of that collapse. We did that, and then we started looking at all the different things that policymakers and monetary policy implementers were doing. And that drove me to say that at that time, and think back, 2001, at that time, we had to change of regime and all those sort of things, had the 9/11 attacks. Then we had the most astounding liquidity event that the world's ever seen. We really did. We saw the Fed completely open the spigots. We saw governments all over the world just absolutely go into crazy deficit spending. Mm-hmm. So I started talking about that, and that's where Fed Friday came from. And meanwhile, knowing that all that's going on, you have to go out and make some money. And so
right.
That's where Fed Friday came from. Very few people were doing that kind of conversation then, so I'm proud of 10 years of pretty good history in it.
Because, as I mentioned before the break, these days, every single word is parsed and people analyze these statements. I mean, I can remember, too, a day a few years ago when there just wasn't this level of attention. So it is interesting that you were jumping in there early, realizing the effects. Tell us a little bit about, we've got about 3 more minutes here, so give us a little bit of detail about what you're looking at this year and why.
Okay. This will be another transition year. The Fed is going to have to decide whether it continues to implement different easing programs, and it's an election year. And so it's highly unlikely there'll be any market collapse tolerated by either the monetary authority or the government side. And they are different, and both are influential. So it's an election year, and we're probably going to be okay despite very serious overbought conditions in most of the equity indices right now. The program, for those of you who have it up on the screen or bring it up, fedfriday.com. You can look up the guest speakers. You can see that it's a continuing education forum. It's not a sales situation at all. We do grant CE credits. It's an absolute, pure program in that regard. We really reach out and try to teach people. Guest speakers are remarkable. We have a senior economist from the Dallas Fed who's quite open and quite opinionated about how things should be, and we'll speak about the imbalances in government finance. We have Wendy Bidwell coming out of Stansbury's group out of Baltimore, who's going to talk about several things, including balanced budget and a potential for having a gold-backed currency and a flat tax system. These are things that call me a libertarian, if you will, but I think would be wise for policy, and I don't mind stating my bias there. Fred Richards, one of the great investors of all time, a long time contributor to the Investors Business Daily system, and a very successful user of a slimmed-down version of CanSlim. And Fred will run live charts, and that is so spectacular to watch. He is the best in the world at that, about where to find what's working and how to invest in it. And he is by no means a buy-and-hold guy and has never had a losing year in his posted portfolio since the year 2000. Remarkable. I'll talk about the benefits that I think are accruing to the United States, chief among them declining energy prices, the availability of a highly educated workforce at all levels, and, oddly enough, water supplies. We are seeing an onshoring of manufacturing here in the United States. It's going to go on for many years. Those are going to be the themes. 4 hours, roughly, of spectacular, high-level economic and investing content. Please attend. It's $50, fedfriday.com. We'd love to have you.
You know, you were bringing up Fred, and we have less than a minute here. I would like to get him on the show as well, because that's what's so interesting. I talk here to a lot of well-known trend followers, people who use different market timing systems, and, you know, a lot of that does tend to often fly in the face of some of these long-term prognostications. But I think you're making a great argument here, Hank, for how to bring it all together with you and your guests. So there's Tom Petty telling us it's time to go. Thank you so much for coming on. Great perspective. I always enjoy hearing this. I learn a lot every time I talk to you. So thanks for joining us, and want to suggest everybody head to Dallas next weekend for Fed Friday.
Thanks, Kate.
All right, talk to you soon.
Bye-bye.
All right, stick around, everybody. We'll be back right after this with more of the Small Cap Roundup.
Folks, turns out my best student became my best teacher. Steve Rhodes absolutely raised my standards, and I'll guarantee he'll raise yours.
Thanks, Tom. What I've learned is that if you want more, you must become more. And that transformation, folks, that occurs the moment you decide to become a master. Now, the quickest way to mastery is through immersion. And for 2 solid days in Denver, Boston, and Tampa, I'll create a new standard of wealth for those few trader investors who have a burning desire to succeed. At my Master Trader course, I'll teach you how to create the ultimate money machine. These are the best-kept secrets in the business. Roadblocks, folks. Dabblers give up when they first appear. Stressors last just a little bit longer, but masters expect roadblocks and achieve extraordinary results when they bust right through them. I have all the benefit of knowing the type of wealth creation that I can generate for you. You don't. That's why I'm making this unconditional money-back guarantee. If for any reason you're not satisfied with my Master Trader course, I'll refund every penny. That's right. I take all the risk, and you get all the benefit. Go to the homepage at tfn.com and sign up today.
Hi, folks. This is Tom O'Brien. If you want to get great trade setups in the equity as well as the option market, come over to TFNN.com and test drive my daily newsletter, Market Insights, for 2 weeks absolutely free. Each trade setup comes with a profit projection as well as stop placement. Included in Market Insights is a Twitter alert service. This allows you to take advantage of intraday setups. Volatility is back in the markets. What does that mean to you? To me, it spells short-term opportunity each and every day. The days of trending up on lighter volume are gone. We have come off the highs with volume across the globe. Don't get caught in a complacency trap. Many of the indices have given back 2 months of trading in 1 week. We have a trader's market. You can take advantage of this trader's market by test driving my daily newsletter, Market Insights, free for 2 weeks. Market Insights will give you the edge you're looking for in the markets. Go to TFNN.com under newsletter. Hit the Market Insight tab for your 2-week free test drive right here, right now.
In the world of financial markets, there's a new player in town with an exciting new way to trade the markets. Nadex now offers binary options as well as bull spreads in a wide range of indices along with commodity and Forex markets. With as little as $100, you can gain access to a new way to trade global financial markets while guaranteeing that your risk will always be capped. Nadex allows you to multiply your trading opportunities in ways never imagined before and access markets you once thought were out of reach. With short-term trading opportunities available, including binary options expiring each hour the market is open, Nadex allows you to take advantage of a variety of market conditions regardless of volatility or market direction. Now is the time to take advantage of this exciting new market. Don't let this trading opportunity pass you by. Open your account today by clicking on the Nadex banner on the front page of TFNN.com. Nadex, a better way to trade.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and the Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Okay, we are back here with the next segment of the Small Cap Roundup, and let's move right back into the theme of the show. Great perspective on the Federal Reserve there in the first half from Hank Mulvihill. We are joined now by Tim Courtney of Burns Advisory Group. And Tim, I understand that you like to emphasize owning small cap and value stocks over the long term. And what I'm always interested in hearing about with advisors who do like the small cap space is how you tend to view those within an overall portfolio. It's actually very refreshing because so many advisors seem to only look at maybe dividend payers or the fixed income space. So, Tim, welcome to the show. Tell us about your investment philosophy.
Sure, thank you. Yeah, and to pick up on what you were talking about just a few seconds ago, the dividend-paying stocks, that seems to be the real focus in the investment industry right now, focus on dividend-paying stocks. And it is kind of important to realize that there's only about 200 companies in the United States that actually pay dividends. You're looking at a very small subsegment of the market. And
well, so 201 now, as of Monday. Sorry.
And, so you're looking at a pretty small subset of the market. And, you know, in the U.S. marketplace there are, you know, about 5,000 publicly traded companies, and most of those are small companies. And so there are lots of ways to deliver value to an investor. A dividend is one way, but also capital appreciation is probably the most tax-efficient way to deliver value to an investor. And that's why we like to have small caps in the portfolio, even though many people don't use those on a regular basis in their allocation.
Yeah, and it seems that in the past couple of years with all the volatility, I mean, obviously that's why the perceived safety of the dividend play has come into favor. But say a little bit more about maybe some of the favorable tax implications of small caps. That's interesting.
Yeah. Well, I think, if you look at the market declines that we've seen over the last couple of years, especially in 2008 and in the early part of 2009, there's no doubt that small cap companies declined more than the large caps. And the large caps didn't perform great on their own, certainly on their own means, but the small caps performed worse. And that's what you'd expect. There are more risks with owning small companies. They don't have as strong of a balance sheet, certainly as the Apples of the world. And they're in a weaker financial position. So you'd expect small caps to decline farther. That's the downside. But the upside is in the recovery since 2009, in March of that year, small caps have far outperformed large caps. And that is what you'd expect during a recovery, is for small caps to outperform. They generally do in recoveries, and they have in this one, by almost doubling the return of the S&P 500 since the bottom. Mm-hmm. And small caps, although they don't pay dividends, they do. They are the early beneficiaries of an economic recovery. The better earnings and the better growth hits their bottom line before it hits the large cap companies' bottom lines. And small caps deliver, fairly tax efficient capital gains to investors because they're not paying out, the 3 and 4 and 5% dividends that a lot of utilities are paying and MLPs are paying. A lot of the consumer staple companies that are paying those high dividend rates. Mm-hmm. That's showing up on your taxable return as taxable income. And small caps are delivering you much better tax efficient returns in the form of capital gains.
Mm-hmm. Now, you were talking a moment ago about how some of these will see perhaps even some of the fundamental growth, which often that I've seen precedes the price growth. But and I know we've talked to a couple other folks on the show who have said that some of these tend to be more U.S. focused rather than international, and in a sense that really has helped their top and bottom line growth. Would you agree with that?
Are you talking about? You're talking about small cap U.S. versus small cap international?
Yes.
Yeah. I mean, small cap in the United States, it has performed better than the small cap internationally recently. We like both small cap in the U.S. and international. The international small companies are actually a little bit cheaper. They're trading at about a 20 to 30% discount off of their book value right now. Mm-hmm. And smaller in value companies in the United States are trading at about a 5 to 10% discount off of their book value. So they're both trading below book value, which is a very good sign. Mm-hmm. That price increases are likely to follow. But yeah, we like both of those areas. They're generally going to be trading much cheaper than large caps, and they are. Today, and they do again, pick up very well during the initial signs of an economic recovery. The large caps are usually the laggards, and so we still see even today, even though we're 3 years really into a recovery from the bottom that we hit in 2009, mm-hmm. on very strong market days, you'll see small caps. Specifically in the United States, moving ahead of the large caps on good market days.
Mm-hmm. And won't you see the opposite as well, that they tend to be more volatile to the downside on bad market days?
Yes, they do. They certainly do. So late last year, when we had all of the issues with Greece and the European markets, the small caps will generally go down more on those down days. But that is how you get rewarded. There's no free lunch. And small caps are a little bit riskier, but over time they have certainly outperformed large companies and the growth companies like the Apples of the world I know Apple has certainly been going on a strong run over the last decade. But over time, those large companies have such great expectations put on them that they're not able to meet them, decade after decade. Mm-hmm. And that's where small caps have the advantage. They don't have the kind of expectations placed on them as the large caps do, and that's why you're able to go and buy them more cheaply. And when you have economic recoveries occurring, those small caps, which have very little expectations, outperform their expectations, mm-hmm. and their stock prices go up. So that's the advantage that the small caps have.
Now, my understanding is that you tend to get your clients into the small cap space via funds. Can you talk a little about that?
Yes. And one thing about small cap funds, most people, the average market investor does not have an exposure to small cap funds. I think only about 2% of 2 to 3% of the entire mutual fund marketplace in the United States is invested in smaller and smaller in value companies. So it's a space that doesn't get a lot of deposits from the average investor. But we like to target that space because the expected returns are so much higher. And on average, going back into the 20s, value and small cap stocks, small value stocks, have tended to outperform the broad markets like the S&P 500 by about 4 to 5% a year. So, the S&P has averaged around 9% going back into the 20s, maybe a little bit more than that, and small and value stocks have averaged approaching 14% going back into the 1920s. So it is more volatile, so that's the risk component, but over time it does deliver better returns, and it's a space in the marketplace that many investors just don't have any exposure to at all.
Tim, do you think maybe is that because maybe individual investors themselves are just hearing so much about the larger companies and feel it's where they need to be in, or maybe do advisors not put them there?
Yeah, I think both. Nobody goes to parties and brags about holding a company that, while maybe it's done very well, it's a small value company. Most people want to talk about the large cap names that they own that they've done very well, that everybody recognizes, and so that usually draws most of the investors' attention. But it does come on the advisor side too sometimes. You hear that an investor will want a high dividend paying investment, or they'll want some brand name investments in their portfolio. And so many times the advisors will direct them away from the small cap space and into the large cap space. But yeah, I think, to go back to your prior question about the funds, one of the reasons we use mutual funds is because it's a very efficient way to go get into the small cap space. There are thousands of small cap companies, and to be diversified, we like to hold as many of those companies as we can, and rather than trying to build up a portfolio using the individual names, which may require us to buy several hundred companies, we feel like we can get a little bit better access and easier access just using a reasonably priced mutual fund.
Can you say something about either specific funds that you like right now, or sectors or regions? How do you go about this selection process?
Yeah, we generally don't try to go and look at an attractive sector, but rather we just look at what are some of the most attractively priced small company stocks in the market today. And you can do that a number of different ways. We like the way that Dimensional Fund Advisors puts together portfolios. They go and find the most attractive small cap companies by running those through a price-to-book measure, and they go by the cheapest stocks that measured by their price-to-book ratio. There are other firms like Fundamental Indexes, Research Affiliates Fundamental Indexes. They have their funds through, I think, Schwab and other companies that you can buy, and they do that based on earnings and a couple of other factors, looking at buying the cheapest small cap stocks based on earnings and I think maybe 6 or 7 other factors. So there are several firms that we like, but no matter how you do it, you're generally going to end up with a portfolio that consists of relatively low-priced investments that have higher expected returns going forward.
Mm-hmm. Let me ask you this, Tim. What is your take on small cap growth?
Yeah, small cap growth is kind of an enigma because you'd expect small cap growth to perform fairly well, but research from just about any university has shown that small cap growth actually has the smallest return of any of the asset classes. So, if you look at the Morningstar style box and you have large cap and mid cap and small value and small growth and large growth, all of the style boxes, the small growth has been the one that's performed the lowest as a group. And so there are certainly other portfolios that have done well in the small cap space, mm-hmm. but on average it has underperformed. And we're not really quite sure why that's the case, but we generally tend to underemphasize small cap growth, and we tend to buy more on the value side, since historically those have had the higher returns. So I don't know why that phenomenon has taken hold, but it has. It's not that small cap growth has performed really badly. It's still done about 8 or 9% mm-hmm. Going back to the 1920s, but it just hasn't had the kind of returns that the small value has. So we tend to go in that direction with our portfolios.
Yeah, that is a little bit surprising, just because I know I do talk to a number of small cap investors through a number of different venues, not just here, but I watch some of these small cap value stocks that just seem to kind of go nowhere for a long time, but maybe that's just in the current market, or recent few years that's happened.
Yeah, that is true. You'll have smaller and value stocks, they'll go through cycles. And generally speaking, when the markets are doing really, really well, small value on average as a whole will underperform. Mm-hmm. So, probably the best example is between 1982 and 1999, when you had a huge market run, and markets were averaging, probably 16% a year in the 80s and the 90s. Small and value companies didn't do as well. They didn't outperform like they normally do. So that is true. You can own some small cap companies and some small value companies, and they won't move, or at least they won't outperform like you'd expect for a long period of time. And then in other time frames, they'll have very, very large outperformance. So mm-hmm. You can have periods of time that are approaching 15 to 20 years where you don't see a huge premium, and you're not outperforming. You may basically have the same as market returns.
Right.
So that that's one of the that is one of the risks of holding that asset space.
Well, there's Tom Petty telling us that this segment's over. Tim, this has been a great conversation, and I really appreciate your giving us some perspective on the small cap market today.
Well, great. That's my pleasure.
All right. Thank you very much, Tim Courtney from Burns Advisory Group. Stick around. One last segment of the Small Cap Roundup. I will be right back.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit tfnn.com today.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Great Basin Gold is a mining company engaged in the exploration and development of 2 emerging gold properties in Nevada and South Africa with a total resource base of more than 23 million gold ounces. Great Basin's Burnstone mine in South Africa opened in February of this year with a resource of 20 million gold ounces, becoming the first mine to open in the historic Witwatersrand Rand Basin in the last 30 years. The Burnstone mine is projected to have a 25-year mine life and is fully financed with production anticipated to be over 250,000 ounces per year at a cash cost of only $450 per ounce. The Hollister mine in Nevada became fully integrated in the 4th quarter of 2010 with annual production estimates of 110,000 ounces of gold per year over the 8-year mine life at a cash cost of only $527 per ounce. Great Basin Gold is cash flow positive and trades on the Toronto and New York stock exchanges under the symbol GBG.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. The Futures Hour, next on TFNN.
Okay, final segment today in Small Cap Roundup. I'm Kate Stalter, your host. It's been a little bit of a different show today. Had a lot of discussion about the Fed, then about small caps. A little different than I normally like to do around here, but always good just to get a lot of perspectives, get the overall knowledge of the market. It really can never hurt. The more you know. Isn't that some commercial, the more you know? I can't remember. Anyway, just over the break, I was kind of thinking a little bit about what our terrific guest there, Tim Courtney, was saying about small cap value versus small cap growth. And it did occur to me after he was off the phone that, yeah, for fund managers, it is more, it matters more kind of how each of these various style boxes, quote unquote, perform over time, because they are longer term buy and hold investors. I think for most of us who are looking at some intermediate trades, maybe swing trading or even holding for a period of time that might be days, weeks, or months, it's a little bit different. You're looking at exit signals to get out of a stock as well as when to get in. So that longer term data, while it may be valid, it would not necessarily affect our ability to profit from a given area of the style box. So I wanted to show you 3 IPOs today, actually, and I've got, if you're looking on Tiger TV, there's just that one big block there on the daily chart for what's called exact target, ET. Actually, let me put that back to there we go. There's a 5-minute chart. That's a little better. So this company raised $161.5 million, priced shares above the range. The media loves this one. They're salivating all over this one today. It's a cloud play, which, of course, explains the media love. But, really, what company doesn't use the cloud today in some way? I mean, is there any company that doesn't? I don't think so. So they've got some good clients here. They're an online marketing firm, by the way. They've got some pretty good clients. Microsoft, Universal, REI, Papa John's. So not too shabby of a client list. That's pretty good. So let's see. From what I was able to look up, the market value would have been $1.2 billion at the midpoint of the proposed range, but shares were priced higher than that. So once all the dust settles, this one could be in the small cap range, could be an interesting one for us to keep track of. Here's another one, VNTV, Vantive. So I've also got that for you there on a 5-minute chart. This one raised $529 million in its IPO. Now I'm seeing where its market value will be around $3.6 billion, so that'll put it in the mid-cap range. Now I know we're the small cap show here, but there's a lot of opportunity in the mid-cap range historically. I know we've looked at Michael Kors on this show several times because that's been a pretty good stock lately. So Vantive is a payment processing firm. So as more payments go electronic, that business looks ripe for growth. Okay, the third one here, I've got a little more time. I can show you this. It's called Caesarstone, and let me see. The ticker is CTSE. Ooh, I don't know. Is this one going to show up? Yeah, there we go. Caesarstone. CTSE. I put that up also on a 5-minute chart. Now, this is getting almost no love from the media today, and I'm sure that's because it's not a tech in any way, shape, or form. It's not even a clothing retailer. So this one is an Israeli company. They manufacture quartz for kitchen countertops, and I'm not joking. That's true. Have you seen those quartz countertops? I think quartz is the new granite. So some of those actually do look pretty cool. So now that the housing market is picking up, who knows? Maybe it's good timing for this particular IPO. CTSE is the ticker, small one, raised $73 million in its IPO. That's all the time I have today. This has gone great. Got some great information from some terrific guests. Always love to hear all the perspectives out there. I hope you enjoy hearing them too. Even if we don't agree with everybody, it's great to hear it. All right, thank you very much for listening today. This is the Small Cap Roundup. Have a great weekend. I'll be back on Tuesday.